If I would have to start trading again from scratch, here is exactly what I would do to cut the learning curve in half. My name is Leah and I'm a trader at Trading Mindset and Data. I've been trading for almost 6 years and I have managed to make over $2 million in the market, and I beat the market each year by a big margin. When I started, making a couple of $100 in the market in a day was a big deal for me. Now I can easily make thousands of dollars with ease. And I think that really changed everything for me. I had to start actually learning and paying attention, which I haven't done before. But even after I figured out my system, there were so many other things I wish I knew earlier. If I had learned these principles sooner, I would have reached this level way faster and saved myself years of mistakes and wasted time. And that's exactly what this video is about. I'm going to give you the knowledge and lessons that took me years and a lot of painful losses to finally figure out how to be consistently profitable. So let's get to it. Number one mistake you should never make is oversizing. If you oversize too much in your trade and you're gonna lose more than 1%, it's gonna be really hard to make this money back. It's a very simple rule. Always risk only 1% of your account on a trade. Sure, sometimes you get lucky when you oversize and the trade goes in your way, but then when the market takes different direction, you're gonna lose all the money very fast. So remember, do not oversize, don't be greedy. It's all based on greed, and greed is really hurting your portfolio. FOMO, fear of missing out, chasing stocks that are up a lot already, not waiting for a retest. Stocks that are up 3, 4, 5% on a day, please wait for a retest. There's only so much juice that you can get from the stock. So for example, if you are up 2% and you are really good with breakouts, sure, play breakouts with a very tight risk management. But if you are not that fast and not good with breakouts, I suggest that you wait for a second chance to enter, because otherwise you will be someone else's exit liquidity. Mistake number 3, trading chop. You will drop. Remember, most traders do really well in trending markets. They can do really well when the market goes up or down. But the problem they have, they fail to recognize that market is range bound and choppy, and they try to force the same strategy and play the same way as they did in a trending market without realizing that the market is tricky. They give back all their gains. So please always pay attention to the market, see the market behavior, see the levels on SPX or Nasdaq, depending what you're trading, and take a step back. Only very professional traders can trade choppy market. It's good for certain strategies such as scalping or selling options. But if you're not excelling in those, you will never lose money with sitting on your hands and waiting for the trend again. And remember, trend always comes. Mistake number 4, rushing into position with no plan. I'm sure you've been there before. You saw a stock flying, it was up a lot, you saw these beautiful big green candles and you just decided to buy and you didn't care. Maybe you buy always 10 shares, maybe 100 shares, but you had no real entry, no stop and no plan in place. And this can only backfire because you do not know how much you're risking to make. So please never enter a trade without having a plan in place. Period. If you miss one setup and you don't have a perfect entry, they say nothing is perfect in the market. I disagree. You can have your perfect entry when it comes to risk to reward perspective. Then just wait for another setup. Let the stock cool off, retest, or get to another breakout level where it digests the supply so you can play it long again. Mistake number 5, buying stocks from furrows. There are so many furrows on social media. Please be careful with that because most of these people do not care about you losing money. They might not even really know these stocks. They're just looking for click bites. They have to post certain content because they want to have clicks and likes and follows. A lot of these people don't even trade. They might just want to share some content to make money off of YouTube or Twitter, you name it. And they certainly do not care about you losing money. So please always do your due diligence. Take the idea, sure, get some inspirations, but then look at the stock, see what the company is doing, see the setup, and see if it actually fits your portfolio and what you want to do with your money. If not, then move on. Please, no FOMO right there, guys. Don't buy a bunch of crappy stocks just because someone posts them on social media. Win rate is unimportant. I cannot stress this enough, but I always see people being fixated on the win rate. It doesn't matter. You can lose 70% of time and still be profitable. Some people just necessarily have to have 9 out of 10 win rate, which means they're most likely taking their gains very early. And if you compare their portfolio with someone who actually sits in the trade for longer, they might lose money more often, but at the end of the day, they might make much more than the people who are fixated on win rate because of their ego. It's nothing else but ego play. So do you want to be right or do you want to make money? It's your choice. Don't buy stocks in stage 4 markdown. This is really deadly for your portfolio. You have to understand the cycle of the market and stocks. Understand the life cycle of these assets. Because if you're buying the dip in stage 2, which is a markup where there is a huge momentum to the upside and you see a little retest to 10 or 20 moving average, exponential or simple, I don't have a preference, or even 50, it's all fine. But if you start seeing that the moving averages, the longer term ones, are about the shorter term ones and it's all getting misaligned and you see that there is pressure to the downside, you're most likely entering stage 4. And that can really kill your portfolio because what people do, they fail to recognize they're in stage 4. They keep buying the dip, buying the dip, buying the dip on every little dip. And very soon, before the stock actually even gets to the bottom, they run out of money. And then they have these huge oversized positions where they are down on them 20, 30, 40, 50%, who knows? And they're just sitting with a huge bag. So A, they're going to freak out and sell with a huge loss, or B, they're going to sit in those positions for sometimes years. So please make sure you know what dips you are buying. That was it for this video. I hope it was helpful. Truly, if someone would explain this to me at the beginning and explain to me that these are one of the most crucial things to know as a trader, I would probably save a couple of years and a couple of $100,000 in losses. So I hope this was helpful, guys. If you want to join our Discord, it's called Trading Mindset and Data. We've read also Substack under the same name where we send people trade ideas and market research every week. And I hope to see you there. Bye.